Welcome back to FitWit. This is Namrata Singh. This is the one destination for all your queries on food, wellness, and finance. Today I'll be talking about debt funds. Debt funds are mutual funds which invest into fixed income instruments such as government bonds, corporate debt securities, and various other money market instruments for capital appreciation. In simple words, mutual funds are lending your money for capital appreciation to the government and companies. Who should invest into debt funds? Debt funds are ideal for investors who need a regular income but are risk averse. Debt funds are less volatile and hence are less risky than equity funds. Now let's look at some of the other benefits that debt mutual funds provide. Debt mutual funds are more tax efficient than traditional products like fixed deposits. In case of fixed deposits, you are liable to pay taxes as per slab rates every financial year, irrespective of the date of maturity. However, in case of debt mutual funds, you are liable to pay taxes only in the year of redemption and not before that. Short-term capital gains tax, which is nothing but the slab rates, will be applicable if you redeem your debt mutual fund within 3 years from the date of investment. However, if you hold your debt mutual fund investment for more than 3 years, then you get the benefits of indexation along with the long-term capital gains tax rate of 20%. Because of the indexation benefit, the effective tax rate is between 10 to 12%. This can be a huge benefit in case you are on the highest tax bracket of beyond 30%. Debt mutual funds are highly liquid. You can redeem your investments at 1 day's notice. There are no lock-in periods and there are no penalties from premature withdrawal. In fact, majority of them do not even have an exit load. Debt mutual funds can also add stability to your portfolio as they are not linked to the equity market. In case of steep corrections, debt mutual funds can act as a cushion to your portfolio. Debt mutual funds can be categorized into different types on the basis of the types of securities that they invest in and the time horizon or maturity of these securities. Let's start with liquid funds. Liquid funds are construed the least risky. They invest in treasury bills having a maturity of less than 91 days. They're ideal for parking spare cash or creation of emergency funds. Ultra short duration funds. These funds are ideal if your investment horizon is between 3 to 6 months. Short duration funds, ideal if your investment horizon is between 1 to 3 years. Medium duration funds, they are ideal if your investment horizon is between 3 to 4 years. Long duration funds, they are ideal if your investment horizon is over 7 years. Corporate bond funds are funds which invest primarily into corporate bonds issued by various companies. Gilt funds invest into government securities of various maturities. Credit risk funds invest into companies which are not rated very highly. They are construed to be the most risky amongst debt funds. Two main risks impacting debt mutual funds: interest rate risk and credit risk. Interest rate risk is basically the risk due to fluctuation in interest rates impacting bond prices. Interest rates are inversely proportional to the price of the bond. So the moment there is a hike in interest rate, there would be a fall in the bond prices and vice versa. We are amidst the steepest and the fastest rate hike cycle that the world has ever seen in the aftermath of the Ukraine-Russia crisis. Most major world economies have hiked rates, which has led to fall in bond prices, and hence most debt mutual funds have not delivered great returns in the last couple of quarters. However, experts feel that the rate hike cycle is behind us and we should start seeing the rates coming down starting early next year. Hopefully, once the rates start coming down, we would see bond prices coming up and the returns getting better. Credit risk is the risk of default due to non-payment of principal or interest. We have seen such credit events in the past, and hence we should try our best to reduce credit risk in our portfolios. Debt mutual funds are less risky than equity mutual funds. However, the returns are not guaranteed and are subject to market risks. Our decision to invest into debt mutual funds should be in sync with our risk appetite, our investment horizon, and financial objectives. If you like our video, kindly subscribe by hitting the bell button below. For all your queries, you can mail us on fitfitglobal@gmail.com. Thank you.